yes, we did have a decent quarter. In fact, we've had a good H1 in terms of the results that we've announced. And this is obviously, if you look at the last 2 years, we were in a recovery mode, as was the tourism industry after the pandemic. I think we are now over the recovery mode and we're into a growth mode on the back of trends that we're witnessing in the tourism industry. As a result of the pandemic, we did a lot of cost re-engineering in the group. If you take Thomas Cook and SOTC, we integrated the back end completely. If you look at some of the other units, during the pandemic, we went down to 50% of our costs. Today, we are at about 70% of our 2019 costs. And we hope to sustain these cost savings over the next couple of years, allowing them to drop to the bottom line. If you look at corporate travel, it led the recovery starting sometime at the end of 2021. And it's at 130% in terms of volume terms as compared to 2019. This has been on the demand from corporates to travel because, after a 2-year period of not traveling at all, I think there was demand. But what we're actually seeing is that demand has sustained, and we're not even witnessing a lot of the long-haul demand because visas continue to be a constraint, whether it is corporate or leisure. If I break up the overseas travel into two parts, one is short-haul holidays and the other one is long-haul holidays. If you look at short-haul holidays, they're at about 70% of what they were pre-COVID. If I look at long-haul, they're only 56% of what they were pre-COVID. Now, the reason for this is that while on the short haul, we've seen an easing of visas, on the long haul, visas continue to be a problem. And we expect that by about the end of the last quarter of calendar 23-24, we will see that issue resolved. So you've seen upside because input prices have grown, but we expect that there will be further upside as visa issuance becomes easier and easier.